What's up, nerds? Today, I want to talk about some under-discussed aspects of market impact. Uh, there was this discussion on Twitter a few weeks ago about market impact models and to what extent they apply to instruments besides stocks. Um, uh, Market impact or slippage is basically if you try to trade a certain amount of a certain dollar volume worth of stocks or futures or other instrument, how much you're going to move the market. So, a widely accepted model for slippage in the quant world is known as the square root law of impact. And what that's saying is, if you trade, let's say, if you trade $1 million worth of something, you're going to move the stock a certain amount. If you try to trade twice as much as that, $2 million worth of the stock, the impact would be the square root of two to what because you're trying to trade twice as much square root of two. So your impact would be 1.4 times or 40% more. So if you move the stock 1%, if you tried to trade twice the amount of volume in the same amount of time, you would move the stock 1.4%, for example. So uh, if you tried to trade four times as much volume, you would move the stock twice as much, the square root of four, twice as much as your original order. So I'm not a quant, but I have a bunch of uncategorized thoughts about how volume finds a clearing price. Some of these thoughts are really just FYIs. I think that they hopefully they're educational, but I think they're at least interesting. And they aren't immediately obvious from looking at order books, and they just seem hard to model. So I'll run through some observations where imposing these models would seem to be very difficult. And at the end, I'll point you to a quant post that offers a mix of insights on how to at least start picking away at the challenges beyond the basic models. Okay, so first of all, models of market impact, like any model, they have assumptions. So transparency and competition seem to be very implicit in these models. But many instruments are traded over the counter or via voice. So not on a not electronically. For example, let's say someone is smashing a stock by unloading large blocks of it in the call around market, and the counterparties here are they're in the standard position of worrying about this aggressive seller having better information than they do, and they will back up off their bids um, uh, as they should. So this is already sort of baked into standard models. Um, but in an opaque market like this, the market impact can be amplified because there's less competition. But there's also this weird dynamic where sometimes it can create an impact in the opposite direction or no impact at all. So um, let's talk about this case where like a lack of transparency exists in the context of this motivated seller coming to market, but a so but the buyers actually have better information than the seller. So take an example where uh, a buyer has correctly anticipated that this order would come in late in the week, and let's say that buyer is a market maker, so they might have been walking the market down. Let's imagine it's an option. They might have been walking the market down for this instrument over the course of the week. They might have gotten short ahead of this order coming in. I call this whole process sort of like setting the table. So they are framing the bid ask in preparation for the seller. Uh, so in this case, when the order finally comes in, the buyer might hold the line and they're not reducing their bid, worried about the seller. They already have framed the market in anticipation of the seller. So, as a matter of fact, they might not lower the bid because the price going down might attract either other buyers or cause their middlemen, which are controlling the sell order, the brokers, to go to the phones and try to solicit other buyers, which would effectively increase the competition for the original buyer. So that original buyer knew they were getting a great deal. They got wind that another buyer might be coming in the market. The original buyer might even step up and say, "Hey, I will buy the entire amount of your volume at this price right now," and it'll sound like a great deal to the seller who has been anchored to this screen that has been framed in anticipation of them. So traders who follow flow very closely understand this dynamic. Like when that sell order comes in, they're going to try to pounce on it. If other traders, and you could have a situation where the other traders were also pre-positioned short ahead of the order coming in, and then one of the sort of strange things that can happen is, let's say the order comes in, and those all the people that pre-positioned ahead of it, they don't necessarily all get a piece of the order, or they get a smaller piece than they anticipated, or the sell order wasn't as big as they thought it would be. So they might actually bid the market up slightly to entice the traders who did get the lion's share of the order to flip for a small profit. And even though they probably shouldn't, because the whole market is artificially low, it's been set this way in anticipation of the seller. The point is, the market impact model would predict that this increased volume would move the price lower, but instead the volume ends up being this beacon that conjures more liquidity at the same or possibly even higher price. So it feels like it would be hard to, and this is probably me just showing my limitations, it feels like it would be hard to disentangle market impact measures in light of this cat and mouse game that happens in the microstructure, especially in the options market. Not that, which is where a lot of my thinking is derived here. We'll start with two related examples, and then we'll kind of fan outward from this. So one is this idea of a lean to market. So which we already kind of talked about in setting the table. So market makers on the floor regularly would lean markets based on their guess as to what direction the paper or the originating order that was coming in, is going. So an option could be worth $5, and the market makers might make the market 485 bid at 495, offered at 495, even though it's worth $5. And what they're really doing is, as soon as the broker, say, comes in with that sell order and offers at 490, they're all going to mug him. They buy him, buy him, buy him. Give me those. Okay. And you might think to yourself, well, if this option's worth $5, why? Maybe I should just go lift the market maker who made this low offer at 495. But they're going to be happy to sell it to you because if they've done their job right, they know that there is a large sell order coming in. So fine, I'm going to sell it to you at 495, knowing that it's about to print 490 when that order comes in. There's some chance that they get it wrong, they're too aggressive, and maybe 495 ends up sort of being the clearing price, but they usually get it right. I mean, they do this all the time. It's their job. Another example besides lean markets is this idea of, we called it getting run in on the floor, but it's basically a situation where paper has a large size they need to move. And there's some stress in there. There's some stress here. Like either market makers have kind of figured out that there is a margin call or a forced liquidation, and the market makers and really the market in general the market impact will be especially large because everyone will front run what is basically a forced liquidation. And so a typical market impact model might not be able to account for that because it's missing the information that everybody knows more about this order and anticipates it and understands the wider context of what's going on. It's not just numbers on the screen. So, traders might sloppily sell ahead of the sell order in order to increase the seller's urgency, create more pressure on them. And, on the floor, the word, we used to call this running somebody in. We'll fan out from these a little bit now. So do some other examples. So cases where market impact models might, they're hard to apply, or you need to take care in how you apply them. One is in ETF liquidity. So if you trade, if you're looking at something like USO or the Corn ETF, CORN, Corn, uh, you might look at these and think that you might estimate some market impact based upon how those ETFs trade, how much volume trades in them, how much shares outstanding there is. But that would be the wrong thing, because the real liquidity in those names is derived. Those are ETFs, and the real liquidity is derived from much deeper underlying markets. The corn futures market is fairly large. The WTI futures market is enormous, and USO and corn ETF are going to inherit their liquidity from these much deeper pools of liquidity, and that's because there's um, arb traders who sit in between the two markets, who are able to create and redeem and able to trade the futures. So you might not think you could move a half a day's volume in corn at a single price, but the right way to think about whether you could or couldn't would be to think about how much volume that is relative to the underlying futures market, not the corn ETF. And I remember many years ago, I had traded a lot of names like TLT and IEF. They used to be iShares, and then BlackRock bought iShares. But I know BlackRock had a tool on their website where you could estimate market impact, and they did exactly this. They benchmarked market impact numbers to the underlying liquidity, not necessarily the liquidity in the ETF itself. And my own experience in trading these ETFs is that the liquidity is much deeper, especially for like these ag ETFs and energy ETFs. It's much deeper than what the screen liquidity looks like in the ETFs themselves. Let's do another example. So let's imagine that there is a fund that has been buying 2 to 5%, say, of the volume of a mid cap stock for the past 2 weeks. They've been accumulating a position for 2 weeks. It's getting to the end of the 2 weeks, and the fund knows that it is done buying. It also knows that its buying must be affecting the stock price. So let's say we're getting to the end of the order, and the fund says, you know what, I'm going to just do a giant overwrite right now. And they launch a bunch of call options on the bid. And the market makers buy the calls, and then they go to hedge the calls, and they discover that there's like an air pocket in the underlying liquidity for the stock. Like they go to short the shares against the calls, and it's very hard for them to get the stock off. And their market impact models for where they price those calls might have been incorrect, because the underlying dynamic in the stock has changed. The stock has had this extra support for the last 2 weeks, and maybe other algos have also pattern matched to that consistent buying over the last 2 weeks, and without that buying there anymore, the stock just has less support than it did before. So the market makers sort of get and their impact models get caught flat-footed. And so again, I'm not perfectly sure if that happens, but a little tribal knowledge makes me think that could be the case. So let's go on to another example. Here's one where a market impact model often might give you the exact opposite signal. So there are cases where if I can do the entire order in options, I would be willing to pay more, not less, for the option. This is a total inversion of the typical relationship between volume and the price that you need to take the risk down. It sounds kind of weird, but it comes from understanding that sometimes if you have to share a trade, like somebody comes in and sells a bunch of options, if I have to share that trade and only get a portion of the trade, and the other people that get on the ticket are like, say, lower capitalized competitors, I might not want to do the trade as aggressively, because those competitors, as they delta hedge that risk that they now have on their books, they're going to cause that vol to self fulfill. So if that trade gets split by enough people, I might not want to do the trade at all, which totally violates this like typical relationship of requiring a better price to do more volume. Instead, I'm actually demanding a better price to do less volume. I kind of refer to this as the tree falling in the forest problem. In the classic riddle, the philosophical question is, does a tree make a sound if there's no one there to hear it, if there are no ears there to hear it? And here it's the order's impact varies by how many people hear it. So if I'm capable of absorbing or diversifying the delta risk from an options trade better than someone else, I can hedge less and not let the option Greeks have a feedback loop on the vol by that would happen from me gamma scalping excessively. So uh, as a matter of fact, I can remember, this is sort of related, but I can remember this little window in time when banks would offer a better price to a customer that traded a lookalike of a listed option, but traded a lookalike version of it OTC. You'd think that in a dark market, that would be a license to rip the customer off, but there was actually a strange inversion. The issue was that the banks wouldn't want the delta impact of the order to be publicly inferred from the option tape, which would cause the bots to chase them for the hedge. So, like a call option, if the call option prints on the bid, all the bots go out there and start selling the stock, knowing that the bank or the liquidity provider needs to go sell the stock. So the algos would go hit the stock first, knowing that there was going to be pressure. Instead, if they would trade at OTC, they didn't have to print the trade at the exact time that it traded, and by doing that, they were sort of free to work out of the deltas on their own schedule without having to race the algos. So they would actually offer a better price in the dark market than in the public listed in the lit markets. Okay. Now we'll go into another category where I just call this bad broker behavior. So market impact can be pretty uneven at small sizes because of this. And just to this is kind of dark stuff, but I remember there was a broker who used to have a couple captive customers in commodity markets, and these customers had no idea. They probably didn't even have screens or anything. They were real customers, they had real physical businesses, and they were kind of small, and they didn't know what the markets were for any particular option. They would just rely on their broker. The broker could lift an offer 10 cents through where the market was if you were to quote 10 market makers, and instead they would just go to their market maker friend that they did a lot of business with, and they would call that broker, that trader up, say, where's your offer, and they would just fill them at that offer price. The customer has no idea. I remember there was a broker like this that I think he lived in Aspen, and he would log on and do fill his customer orders. He'd work for 20 minutes a day and then hit the slopes for the rest of the day. I mean, it's just this is these little pockets of things always kind of exist. But another one like that was more bad broker behavior. There was a broker that was cold calling some market making groups that he got a list of them. And I remember he called us and he asked if he could negotiate his rate on the trade basically based on how badly he ripped off his customer, right? So it's hey, if I were to pay you this for the option, essentially, could you cut me in on some of the edge by adjusting the brokerage rate that you paid me? I mean, he used coded language to say all this, but I mean, just told them to lose our number. These fly by night hucksters they're always kind of coming and going in these markets. That one me and my old business partner, like even in hindsight, we refer to that call as like the shakedown. But bad broker behavior exists for large orders too. Um, so like there's this subset of large option orders that go through the equity options markets that do not get shown to the street or large market makers or hedge funds. They basically get filled by very well capitalized traders that are like backed at, and they happen at these block prices. The trades have a lot of edge. Granted, there's a lot of risk in the trades as well, but on the whole, the traders who see these prints but actually can't get on them and can't participate in these trades think they trade too fat because they would be willing to trade them at better prices. And the question is why don't those large trades get shopped to the big market makers, to the big boys? Why are the brokers that control those orders just cozying up to this like very tiny cabal of traders? They're the only ones who get the look. And this is me being a little speculative, but like one theory could be that a lot of the large players, large market makers, they have their own sales desks. So if the brokers start trading with the big players, they risk one of these players figuring out who the end customer is and basically stealing the client. And these clients are very lucrative to the brokers that have those small brokers that have those orders and control those orders. So they don't want to risk having their clients stolen. And then presumably the clients are okay with the prices that they are getting. They don't seem to be necessarily, or the level of service that they're getting is not enough for them to look elsewhere. So the brokers that control the orders, they basically have an incentive to keep their circle very, very small. And one thing is like there's this little trend happening right now in the options market where a lot of the big players are putting traders back on the exchange floors, like on the P Coast and Chicago. And I presume that's because they're trying to have a chance at breaking up those orders because these orders need to be crossed on the floor. So this is a chance for them to sort of like break up the order at the exact point of execution and printing. Anyway, so all this stuff I'm kind of talking about, it is a bit dark arts, and it's more relative to derivatives trading where the trading is chunkier. You don't really VWAP options orders. Even the fact that there's 17 exchanges in options is kind of interesting. Like, the story that's told is one of competition, and all these exchanges allow us to experiment with different ways of organizing an order book and matching engines and customer choice and capitalism, America, like all good things, right? But I don't know. There's an old quote I learned as a teen from a Skid Row song called where it was like, "You say it's raining, but you're pissing down my back." I mean, I really feel a little bit more tinfoil hat on this topic because when I think of there being 17 exchanges, I think that's how many there is right now. Like the cost of ingesting a direct feed from every single one of these exchanges so that you can quote on it just means that your fixed costs would be very high, which feels like an arrangement only. It's a fragmented arrangement that I feel like only the large players, sort of like the oligopoly of market making, could really be a fan of. I mean, it would make sense, I think, for them to support yet another pet exchange where they can cross orders or internalized flow near the bid and ask without the risk of it being broken up by somebody else. So I don't know. I'm happy to hear what current market makers think of my little pet theory there. Okay, let's start winding down. As always, models are limited representations of reality. That's a feature and a bug. My guess is that impact models become increasingly buggy when you get to derivatives because of the choke points where the rubber meets the road. Execution. It's very hard to hide what you're doing. And this is, by the way, this is like, I'm not even discussing how option market makers can see their counterparties clearing firms. There's like a tagging system that allows them to classify. I mean, smart market makers can use this tagging system to basically classify signature flow behavior. So there are significant differences basically in trading options than trading stock. It's possible, I would think it could be possible to adjust market impact models to account for these differences. Sure, there's some savant working on some agent-based model of market impact that might as well be in Klingon for as far as I'm concerned. But I guess this stuff probably all does get solved eventually. If you want to read something that is very smart on this, as opposed to me sitting here recounting stories, I did reprint a blog post by an anonymous quant. I got permission. I put it on the blog. It's called Market Impact and Strategic Execution. I will link to it in the comments. But I think I really like this post because it appreciated a lot of the real world complexity that I'm sort of alluding to, but it bridges, my pub talk to educated language. Um, I'll actually share a few great quotes. Hopefully you'll read this. Uh, okay, I'm just gonna start reading here a little bit. The dirty secret of market impact. It's messier than anyone admits. This article challenges conventional models by looking at how information actually flows through markets. Here's the real problem. Impact hits differently when you're getting in versus getting out of positions, a fundamental asymmetry that most models miss entirely. Add in the fact that every major player's algos are scrapping for the same liquidity, and traditional execution models fall apart. So I love this exact quote because as a market maker, we always had this saying like, hey, you might beat us on the way in, but if you close or you roll, we got you. So I liked how it sort of recognized this thing that market makers already know. Let's continue. By diving into the weeds of price formation and what drives liquidity providers, we crack open why impact behaves this way. The result: a framework that bridges pure theory and trading reality, giving you both the mathematical firepower and street smart tools to optimize execution in markets. Markets aren't as clean as the square root law of impact. Impact comes from a brawl between volatility feeding on itself, how fast the market digests your trades, and dealers trying to figure out if you know something they don't. This changes how we need to think about moving size in markets. At the heart of our framework lies the recognition that trading activity both responds to and generates volatility. Consider a large institutional trader executing a significant position. Their trading consumes liquidity and reveals information, and also increases local volatility. That same volatility changes how the market reacts to their next trade. It's like throwing stones in a pond where each splash affects how the next one ripples. Classic impact models completely miss this self reinforcing cycle. No model's perfect. This one's useful not because it nails every market move, but because it gives us a solid framework for thinking about how trading pushes markets around and how markets push back. Long term is where it gets really twisted. Trades that set off these vol feedback bombs, they tend to leave permanent marks on price. Why? Because the market's reading these vol spikes as smoke signals. Where there's smoke, there must be fire. It throws the whole temporary versus permanent impact debate out the window. Instead, think of it like this: the bigger the vol feedback, the more likely the market thinks you know something they don't. Price discovery through chaos, basically. Our framework also reveals the strategic behavior of market makers and other liquidity providers. Their quote adjustment process now explicitly incorporates volatility feedback through a response function. Anyway, the post goes on. There's a bunch of math symbols and stuff. Like I said, I'll link to it in the description. And overall, I hope, like I said, I hope you found this interesting, if not educational. That's all for now.